Hello everyone, today we are going to present why Thailand has to increase in collecting tax. So let's begin with the tax-based category that everyone should know so that we can pay tax correctly. There are three categories of tax base, which are income tax and incorrect based on the income, such as personal income tax or corporate income tax. For the personal income tax, it is an annual tax collection from the income or return on investment, and taxpayers have to pay by 31st March of the following year. Moreover, the government also determined the criteria for paying a tax. For those who have a net income not more than 150,000 baht in the throughout year, they don't have to pay a tax. But people who have a net income of or year over 150,000 baht, they have to pay a tax according to the criteria that the government have set. And the second one is property tax, which is tax collected on the assets, including tax on property, vehicle, or land. And for the last one is value added tax, or another name is called VAT. In Thailand, it charges 7% of VAT when we purchase some goods or service. And according to the like concern, it can be seen that the most tax revenue in Thailand come from the added value tax. So this become one important factor why Thai government will increase the VAT from 7% to 10%. However, if the government increase the VAT, so most people will consume less and save more, which is not good for the economy. So the thing that the government should do is expanding the tax base instead of increasing the VAT.
The reason why the government can collect other types of tax less than value-added tax is that Thailand has a relatively high proportion of the informal economy. Thailand is a developing country, and the proportion of the informal economy is quite high, so it cannot be collected as a tax in many activities, such as shopping at the market or when workers are paid in cash. These activities are not recorded for the government to track. Therefore, the power of the state to collect tax is less. One characteristic of the Thai tax system is that it places too much of a tax burden on salary workers. When it comes to personal income tax, the number of people who actually pay taxes is only about 10% of the total labor force, or about 3 million people. Of this number, 80% are salary workers, 14% belong to businesses and specific professions, and investment and assets account for approximately 6%. From the latest statistic, from a sample of more than 71.7 million Thai people, there are 61.2 million internet users, or up to 85.3% of the population. Small trade via social media are normal for Thais, but these businesses can actually avoid tax. This is because the government cannot check everyone's financial channels. Can you think of how many untaxed transactions there are when there are so many people using the internet?
To bring those who are out of the tax system into the system, the Thai government have various ways to do so, and it varies in each area. I would like to show you some case study from Australia. When Australian government successfully brought online sellers into the tax system, they combined various methods together, and they focus on working on three parts. First, Australian government implement a law on an imported low-value goods which lower than 1,000 Australian dollar would be subject to goods and service tax. This means that online sellers are now required to register for GST and charge it on their goods if their sales to Australian consumers exceed this barrier. Second, they cooperate with the online marketplace platform. They put the responsibility of collecting and remitting the goods and services tax on the online platform. Online marketplaces such as Amazon, eBay, and Alibaba are required to register to the goods and service tax system. Third, the Australian Taxation Office implemented an online registration system specifically for online sellers. They created an easy-to-access system to facilitate and encourage them to join the system. They also utilize data analytics and monitoring tools to identify non-compliant sellers. They collected data from online marketplace and cross-referenced it with GST registration records to identify sellers who were not meeting their tax obligation. Thailand can study this case study of an Australian government brought their online seller into the tax system and apply into the most appropriate method to the country. For example, for another informal labor, the Revenue Department can working with the Department of Labor Protection and Welfare to bring those informal labor into the tax system. In the current situation, it is still hard to bring all the informal labor into the system because the government cannot measure the accurate data of the informal labor. But if Thailand were able to bring those informal labor into the system, Thailand could gain a lot of benefit from the tax income and others. Thank you for your attention, and these are our source of reference.